This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
A damaged oil pipeline component that disrupted output at several offshore U.S. Gulf of Mexico platforms was repaired late Friday, a Louisiana official said, with producers moving to reactivate some of the halted production. A failed flange connecting two onshore pipelines operated by Shell plc in Louisiana leaked an estimated 2 barrels of oil. The oil, which spilled onto an area covered with gravel, has been removed, said Chet Chason, executive director of the Greater Lafourche Port Commission, and the flange had been repaired by Friday evening, he said. The spill halted operation of two pipelines that bring oil from several production facilities off the Louisiana coast, curtailing about 600,000 barrels per day of output from Shell, Chevron Corp and Equinor, according to two people familiar with offshore operations.
Europe is heading into winter with seasonally low levels of diesel in storage tanks, with major implications for the continent's industries and drivers in the run-up to EU sanctions on Russian crude oil and refined product supplies. Diesel, along with other distillate fuels such as heating oil and gas oil, are the lifeblood of industry with uses ranging from powering factories to heating homes, in addition to being used as a motor fuel. When Russia, which supplies Europe with about 60% of its import requirement, invaded Ukraine on February 24, the diesel market went into shock as it priced in a possible cut-off of those supplies.
Moving on to the top news in the energy sector.
Oil prices plunged around 2% on Friday, on expectations that supply disruptions in the U.S. Gulf of Mexico would be short-term, while recession fears clouded the demand outlook. Futures, however, were still on track for a weekly gain. Brent crude futures fell $1.45, or 1.5%, to settle at $98.15 a barrel, while U.S. West Texas Intermediate, WTI, crude fell $2.25, or 2.4%, to settle at $92.09 a barrel. Both contracts gained more than 2% on Thursday. We are pulling back a little bit after the big run-up yesterday, said Phil Flynn, an analyst at Price Futures Group.
India said on Friday there was no pressure on it from Western countries or anywhere else over its energy purchases from Russia, as Indian firms step up imports of oil and coal from the country shunned by some governments for its invasion of Ukraine. India, the world's third biggest crude importer, overtook China to become the biggest buyer of Russian oil in July based on seaborne volumes, having bought very little from the country before the start of the war in Ukraine in February. Also in July, Russia became India's third-largest coal supplier, up from the sixth position historically, as discounts drove shipments to a record. Next, we have the top news in metal markets. Slowing economic growth is weighing on industrial metals prices, but zinc and aluminium are likely to outperform if sky-high energy prices force European smelters to cut output further, leading to larger shortages. Prices of metals including copper, aluminium and zinc have tumbled between 20% and 50% from record highs in March as interest rate rises tilt the world towards recession and weaker metals demand. But the price of energy used by smelters has shot up, particularly in Europe, which has less Russian gas and oil since Russia invaded Ukraine, and further price rises are expected in winter.
Gold prices drifted higher on Friday, helped by a drop in U.S. Treasury yields and setting the metal on path for a fourth straight week of gains, as investors took stock of the recent inflation data out of the United States. Spot gold rose 0.5% to $1,798.86 per ounce by 1800 GMT and was headed for a more than 1% weekly rise. U.S. gold futures also settled up 0.5% at $1,815.50. Currently the gold market is seeing some short covering and is supported by lower yields, said Bart Mellick, head of commodity strategy at TD Securities.
We will now look at the top news in the agricultural sector.
U.S. soybean production will be bigger than previously forecast as better than expected yields will more than make up for a cut to acreage, the government said on Friday. Corn production was seen lower than the government's July outlook. The soybean harvest will come in at a record 4.531 billion bushels, while the corn harvest was pegged at 14.359 billion bushels, according to the U.S. Agriculture Department's monthly World Agricultural Supply and Demand Estimates report. That compares with the government's July harvest estimates of 14.505 billion bushels for corn and 4.505 billion bushels for soybeans.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.